What if I told you that in 2026, the biggest mistake most American investors will make isn't picking the wrong stocks, it's thinking they're diversified, when in reality, they're holding the same handful of tech giants and index funds as everyone else. Millions of American investors from New York to California believe their portfolios are safe, yet many are unknowingly exposed to concentrated risks. Interest rates have shifted, inflation is reshaping consumer behavior, AI is redefining corporate earnings, and supply chain transformations are still unfolding post-pandemic. So the real question isn't simply which stocks will go up, it's which companies are positioned to dominate the next economic cycle in America and offer both stability and growth potential. Today, we're breaking down the top 10 stocks investors on YouTube are betting on in 2026, a list designed to give U.S. investors a balanced approach to wealth building. Before we dive in, make sure you hit the like button and subscribe, because every week we break down complex financial strategies into clear, actionable insights tailored for American markets. Microsoft is more than just a software company. Its Azure cloud division powers the majority of U.S. enterprise infrastructure, from small businesses in Texas to Fortune 500 companies in California. Microsoft is also a leader in AI, thanks to its partnership with OpenAI, integrating AI tools into Office, Windows, and enterprise platforms. The company's AI initiatives are projected to contribute significantly to revenue growth through 2026, positioning Microsoft at the forefront of technological transformation in America. For U.S. investors, Microsoft represents a core holding for multiple reasons. Its balance sheet is robust, with tens of billions in cash, allowing flexibility during downturns. It pays a consistent dividend, rewarding long-term shareholders. Its enterprise software business ensures recurring revenue that isn't easily disrupted. And the AI exposure positions Microsoft to capitalize on the technology revolution unfolding in America. Apple dominates consumer electronics, but its value extends far beyond iPhones. Services such as Apple Music, iCloud, Apple Pay, and subscription-based offerings now make up a growing portion of revenue. This recurring revenue stream provides stability even when product sales fluctuate. In a higher interest rate environment, companies with strong cash flow, brand loyalty, and ecosystem control, all strengths of Apple, are likely to outperform. For U.S. investors, Apple represents both a defensive play and a technology-driven growth opportunity, especially as AI and device integration accelerate in the coming years. Berkshire Hathaway is a unique case. Founded by Warren Buffett, it combines exposure to multiple sectors, including insurance, railroads, energy, consumer goods, and equity stakes in major companies like Apple. For U.S. investors, Berkshire represents diversification within a single company, offering stability during volatility. Its large cash reserves allow opportunistic investments when markets dip, making it both a defensive and strategic pick. Historically, it has performed well through economic transitions, providing reassurance to U.S. investors wary of cyclical downturns. Amazon is often associated only with e-commerce, but its AWS cloud division is a driving force behind enterprise adoption in the U.S. Amazon blends growth potential with stability, benefiting from e-commerce dominance, cloud computing expansion, AI-driven logistics, and cash-generating operations. Investors across YouTube frequently cite Amazon as a must-have for American portfolios because it straddles the line between reliability and aggressive innovation. Healthcare adds another layer of stability. Johnson & Johnson, a giant in pharmaceuticals, medical devices, and consumer health, offers U.S. investors consistent dividends and minimal exposure to volatile tech cycles. Similarly, Procter & Gamble, with brands like Tide, Gillette, and Pampers, remains a defensive play with predictable revenue, strong margins, and reliable returns. So far, these 6 companies, Microsoft, Apple, Berkshire Hathaway, Amazon, Johnson & Johnson, and Procter & Gamble form the core of a balanced U.S. portfolio. They represent a mix of technology, consumer staples, healthcare, and diversified investments. They're not flashy, but they are essential. They're the stocks that help investors sleep at night knowing there is a strong foundation beneath them. In the next segment, we'll explore the 4 high-growth picks, the companies that offer Americans exposure to AI, innovation, and aggressive upside potential. These are the stocks investors on YouTube are betting on for outsized gains in 2026, but they come with higher risk. Stick around, because this is where the real opportunity lies. As we continue building the foundation of a 2026 U.S.-focused portfolio, it's important to understand the role of these stable core stocks in different market conditions. Investors in the United States have faced unprecedented challenges over the past 5 years: rising inflation, interest rate hikes, and geopolitical uncertainty. Companies with predictable cash flows, strong brand loyalty, and diversified operations tend to outperform in such conditions. Amazon exemplifies this dual nature. While it is known for e-commerce, its Amazon Web Services division generates the majority of its profits, serving corporate America and government clients alike. Cloud adoption in the U.S. is expected to continue growing at double-digit rates over the next several years, and Amazon is positioned perfectly to capture this growth. Moreover, Amazon is integrating AI across logistics, supply chain management, and personalized shopping, further strengthening its growth potential. Healthcare stocks are another pillar for U.S. investors. Johnson & Johnson remains an attractive holding because it balances stability with growth. Its pharmaceutical division innovates continuously, while medical devices and consumer health products ensure steady revenue. Dividends are consistent, which appeals to American investors focused on income, particularly retirees seeking predictable cash flow. Consumer staples are equally critical. Procter & Gamble provides stability in uncertain times thanks to trusted brands and a resilient business model. U.S. investors rely on companies like P&G because everyday demand for household essentials is relatively inelastic, meaning it's less affected by economic downturns. The company's efficient operations and strong margins contribute to long-term value creation. These 6 stocks collectively represent the core portion of a balanced portfolio, typically recommended at 60% allocation. They cover multiple sectors, reduce risk, and provide a base for strategic growth. The remaining 40% is allocated to high-growth and aggressive plays, the companies that have the potential to dramatically outperform if market conditions favor innovation and AI adoption. For Americans who follow finance channels on YouTube, this balance is widely discussed. Comments, analysis, and trending watch lists consistently highlight that combining a stable foundation with calculated exposure to growth is more effective than chasing volatile trends or single hype stocks. In the next section, we'll dive into those high-growth companies, analyzing why investors believe they could outperform in 2026. We'll also explore how their technology, AI integration, and market positioning make them attractive bets for U.S. portfolios, despite the higher risk involved.
Now let's shift to the high growth portion of the portfolio. These are the stocks that are generating excitement among American investors on YouTube, particularly those focused on AI, autonomous systems, and emerging technology trends. NVIDIA is at the forefront of AI-driven computing. Its GPUs power everything from data centers in Silicon Valley to research labs across the United States. AI adoption is accelerating in sectors such as cloud computing, autonomous vehicles, and enterprise analytics. For U.S. investors, NVIDIA represents an opportunity to participate directly in this transformative wave. While the stock is more volatile than Microsoft or Apple, the upside potential is substantial. Tesla is not just a car company, it's a symbol of innovation and AI integration. Autonomous driving, energy storage solutions, and AI-powered manufacturing give Tesla exposure far beyond electric vehicles. Many American investors see Tesla as a high-risk, high-reward play that could redefine transportation and energy sectors over the next 5 years. Palantir Technologies is another aggressive AI stock with government and enterprise applications. It specializes in big data analytics, providing AI-driven insights to organizations across America. Palantir's contracts with the U.S. government and major corporations make it an attractive, albeit volatile, investment for investors willing to tolerate short-term swings in pursuit of long-term growth. Finally, ARK Innovation ETF offers exposure to a basket of high-growth companies in AI, genomics, robotics, fintech, and other disruptive sectors. U.S. investors appreciate ARK Innovation because it diversifies risk within innovative industries and provides a scalable way to capture trends in technology and science. These 4 high-growth stocks, NVIDIA, Tesla, Palantir, and ARC Innovation complement the stable core holdings, creating a balanced U.S. portfolio designed for 2026. This combination provides both the reliability of foundational companies and the potential upside of innovative sectors.
Having covered all 10 stocks, let's discuss strategy and risk management. Essential for any U.S. investor. A balanced allocation is critical, approximately 60% in core, stable companies and 40% in high-growth plays. This structure reduces portfolio volatility while capturing potential upside in AI and emerging technologies. Risk management is equally important. Avoid investing money you cannot afford to lose. Diversify across sectors like tech, healthcare, consumer staples, and AI, and consider dollar-cost averaging over time. Maintain a long-term perspective, particularly for growth stocks, which may experience short-term volatility but have potential to outperform over 3 to 5 years. Behavioral factors often influence U.S. investors. Many fall into the trap of chasing hot stocks without research, ignoring dividends, or overexposing to one sector. Recognizing and correcting these tendencies can significantly improve outcomes and reduce stress. In conclusion, the top 10 stocks investors on YouTube are betting on in 2026 provide a carefully balanced approach for American portfolios. The stable core companies, Microsoft, Apple, Berkshire Hathaway, Amazon, Johnson & Johnson, and Procter & Gamble offer safety and consistent growth. The high-growth picks, NVIDIA, Tesla, Palantir, and ARC Innovation ETF introduce exposure to the AI revolution and other emerging trends. If you found this breakdown valuable, hit the like button and subscribe to our channel for more US-focused finance insights, weekly analysis, and actionable strategies for 2026. Turn on notifications to stay ahead in the fast-paced world of investing. Remember, balance, research, and discipline are your keys to long-term success in the American market.